welcome. We are delighted for you to join us. We are here to talk about multi-capital risks and opportunities. We're going to cover a little bit of both. I am professor of accounting at Houston Baptist University, and I come to sustainability from the perspective of accounting valuation and enterprise risk management. And so I will stop talking about myself now and throw the floor open to my three esteemed colleagues to introduce themselves as well.
Emily, you want to go first?
Sure. Hi, I'm Emily Chasen. I'm Director of Communications at Generate Capital in San Francisco. We are one of the leading sustainable infrastructure providers in the US, and looking forward to talking to you all about that in a little bit. Some of you may know me from my previous career where I was a journalist that wrote about sustainable finance and accounting. So I'll have a lot of perspectives to share today.
And I'm Paul Herman, and I'm bummed to not hear from Emily every day, like the past several years. Breaking news about the environment and governance and how the world can be better. But delighted she can join us today on this panel. I'm Paul Herman from HIP Investor. HIP stands for Human Impact and Profit. And delighted that this is the 10th year of this conference focusing on new metrics, now rebranded as Integrate. And at HIP, we produce and license 125,000 ratings of stocks, bonds, and funds. And then we manage portfolios like the Great Places to Work and fossil-free portfolios. Daniel?
And I'm Daniel Aronson, and I'm very happy to be here with this great group and with everybody who's here. I am the author of a book called The Value of Values, which is coming out in a couple of months. I'm actually sort of rushing to finish the manuscript, actually. And my company, Valuetis, we build tools and we do measurements for things like the full impact of plastic. We build tools to make materiality twice as fast and better. And we build risk visualization tools that we will be talking about a little bit today.
Okay, thank you so much. We talked a bit about how to organize our session. We decided in the interest of time, which of course is a scarce commodity, that we would each begin by showing you something, a little bit of show and tell, an image or two that we felt was very important to imprint upon your minds. And so what we're going to do is go round robin. We'll do this little bit of screen sharing and show and tell. Then we will open up and have a conversation about what we are sharing. We also have a small number of polling questions. No, nobody is being elected. It's just a survey, set of survey questions, so please don't panic about that. But that is our plan for the remaining time. We also invite all of you to write your thoughts and comments and questions, whatever else you wish, keeping it clean, of course, into the chat room or the chat box. All of us, all four of us, can see the chat box and would be delighted to welcome you into the conversation. So without further ado, shall we continue in the same go-around, perhaps, to do a little bit of screen sharing?
Yeah, Emily, you're going to tell us what types of capitals there might be, right?
Yeah, so this panel is called Multi-Capital Risks and Opportunities Highlighted by COVID-19. And what's been fascinating about being in the sustainable finance world for a long time is that we think of capital a little bit differently than most people. So let me see if I can share my screen quickly. And there you go. So at Generate, we actually think about resources a little bit more as sort of a type of capital and how all our resources are connected. And the sustainability challenge is really to take these resources and get them where they need to go through infrastructure. And we view it as more of an infrastructure game than an innovation game. So you can see how all of these different resources are actually connected. If you want to do something in food, you also have to think about land and water and energy and materials and how it's all connected. And it's the same for each one as you go around So that's sort of how we think about capital, is that all of these world's critical resources are connected, and we need to take them in a way that they affect each other to a more sustainable form of delivery. And one way to think about how we use resources now and how we could use resources in the future is to look at this map of Atlanta, Barcelona, two cities with pretty much the same population, but they use resources in a very different way. This was pre-COVID, to look at sort of the carbon emissions from Atlanta's built-up area versus the carbon emissions from Barcelona's built-up area. So there are choices that we can make about how we use our resources. And I wanted to add in here the COVID-19 impact. That this is a chart showing the global daily fossil carbon emissions and how rapidly it shifted in COVID. So you can take these charts from before COVID and know that they are totally different today. So we can change things, but we have to rethink sort of how we are delivering and using information. And you'll see that a lot in the way that cities and communities are trying to respond to COVID and the sort of building back better plans. And then just to talk lastly about the overall areas where we're really focused, and you can see everything from LEDs to electric vehicles. This is an older chart from McKinsey, but it shows a little bit about how the resource revolution and making our resources more productive for us is a 2.9 trillion opportunity in 2030, at least. So there's a lot of potential ahead of us if we focus on sort of going from millions to billions to trillions in sustainable infrastructure. And that's it from me.
Great, thanks, Emily. And what was very insightful about your charts is that they show the tremendous opportunity, but also the positive return on investment. So whenever you see a cost curve like that from McKinsey, it means something below the line is a positive return on investment. So I will share my screen here and welcome everybody. Daniel introduced that his book is coming out. Some of you may know that we have a book called The Hip Investor, which is now 10 and a half years old, launched on Earth Day 2010. And the new Global Handbook of Impact Investing is coming out in December. So great for a holiday gift. So Emily talked about COVID. One of the things that we did early when COVID broke in February, March in the US was to go build a map of what the health risks, healthcare capacity, and transmission risks, including incorporating things like Google's mobility data by county, as well as state policy. And you can see, this is a green, yellow, red graph. You can see a lot of the red and orange is in the Southeast United States. And that happens to not only be because of the health risks like higher obesity and higher diabetes and lower ICU beds, but it also tends to overlap frequently with diverse communities and people of color. So this is, again, a 3,000 county map that there's data to track all of this from a multi-capital perspective that includes health and wealth and equality. And here's a climate threat resilience map. And again, this is a 3,000 county model based on data from the Environmental Protection Agency, which will be delighted that they can now release data again in the new administration. And you can see again in the Southeast where there's tremendous weather risk, physical risk. There's buildings along the coast of Florida. There's oil refineries in Texas. So these are both the threats and the lack of resilience from the lack of policy. So you can see that the COVID geography and the climate geography both overlap. And if you were considering investing, let's say in real estate in Florida, you might want to only focus in Gainesville because that's one of the few places with a high altitude. So finally, a third chart that we want to show is this is how dollars are put to work by states in the US and the benefits to citizens, including affordable housing and income equality and equality of opportunities. And what's really compelling about these three graphs is whether you from a COVID, climate, or citizen perspective, living in the Southeast has a lot of risks. And that from an investor perspective, which we advise investors and advisors and fund managers, you might say, well, let's avoid those areas. Let's avoid the South and Southeast because of all those risks. And that might be okay in the short term to minimize those. But in the long term, there's an actual capital gap as well as an investment need. And so the challenge is how to use those frames about capital to do that. Because what we've found is that the higher the sustainability of a company, the higher the shareholder return, and the lower the sustainability of a company, the lower the shareholder return. So I'll just stop right there, and great, I'll stop right there and use that as input to our conversation. Daniel?
Great, thanks, Paul. Thanks, Emily. I have to say, this is a terrific group, and there's some fantastic stuff. I love the visualizations. What I want to do is step back a little bit and take a little bit of a bigger picture to talk about what we're missing. This is multi-capital risks, and I want to just mention what we're missing and how we should do better at thinking about it. So, for example, one of the things we're missing is that there are different levels of support that underlay our economy and our business. And when we miss risks to bedrock, like nature and social cohesion, that means if there's no social cohesion, if nature does not provide the level of consistency and predictability, then we miss out. If there's no infrastructure, if there's infrastructure problems, a new report in Science says $14 trillion in infrastructure is at risk and is likely to be destroyed. 14 trillion with a T. If that happens, what does that mean? What if there's a shift in these infrastructures, right? What is the risk and what falls down? For example, Paul was just talking about real estate. According to a recent report, over $6 billion of real estate value has already been lost in just New Jersey, New York, and Connecticut already. Now, because real estate is between a quarter and a half of the net worth of the average American family, much more than their stock portfolio, what happens when that gets pulled out? What does that mean down the line? Is this something that we saw in 2008, for example, with real estate dragging down the economy? And then there's the question of how do we zoom out, right? How do we actually take a look at this? If you look at these things, it looks disconnected. But if you zoom out, you say, hey, there's some sort of pattern here. And if you zoom out more, you see risks. You see things that you didn't see before. And then the question is, okay, great, how do we visualize those things? And that's the part that we need to visualize more of, which is, what do we do about this stuff? So, for example, we have a dashboard that visualizes risks and allows you to look at them, the submerged risk, the hidden risk, allows you to look at them by threat type, for example, environmental. It allows you to look at them by geography, for example, just in Africa or in Europe or what have you. This is the kind of performance that we expect that helps our planetary duty and also helps our fiduciary duty. If we don't do things like this, we end up with fiduciary duty problems. And that's why values have value, because they help us see these things, react to them, and stop these risks from causing financial and planetary damage.
Okay, so I'm banning cleanup, I guess, to use the baseball term. And I'd like to wrap up this first segment of our time together by addressing a question that actually took up a fair amount of our time in the preliminary conversation we had, which was basically just how many risks are there? How many capitals are there? Mean to be a capital. And so to do that, what I want to do is take you to not the original 6 capitals model, but the new draft revision that just came out. They've been working on it this year, still out in draft format. And let's see if I can get my screen share to actually share. And okay, can you guys see that?
Mm-hmm.
Okay, yes, you can. Well, it's, it is a small, let me try one more time. Share, okay. So once again, can you guys, yep, there we go, okay. Well, you may not be able to see the small words easily. Let me describe what you're looking at, and then let me describe how this differs from the original integrated reporting framework that came out, I guess about 8 years ago at this point. So the idea is that you have 6 capitals, and those are the tentacles of the octopus, so to speak. Those tend to be referred to, at least in accounting, as the resources that you must invest in to create value. And down the 6 capital list on the left, you have financial, manufactured, intellectual, human, social and relationship, and natural. And you can think of those as the financial elements of the model. You have strategic elements of the model, which is the blue circle in the middle, ranging from mission and vision to risks and opportunities. And then you have the operational components of the model coming through the middle. You must take inputs, you conduct activities, you produce outputs, and then you have outcomes as well. So if you're looking at this picture, and if you're thinking, Mike, you must have made a mistake that looks like the original model. Yes, it does. And believe it or not, after 8 years of thinking about how to change it, there are only 2 or 3 very small revisions. So for instance, at the very top middle, instead of saying that the initial strategic component of your business model should be your understanding of your mission and vision, they threw in the word purpose. And they highlight. Now, why purpose? Isn't mission and vision purpose? Yes, I have noticed, and as an accountant, this has wounded me severely, that the 3 Ps, which have always been described as people, planet, profits, are starting to be described here and there as people, planet, purpose. And some people are dropping the profits. Again, you can understand why, as an accountant, I would find that this, but I'm learning to deal with it. In addition, 3 of the 4 operational circles are still blue, as they are in the original model. The one that changed, though, is the one on the right, which suddenly has turned brownish. And instead of referring to outcomes in general, as opposed to outputs, which are things that you produce to sell, outcomes had thought of as long-term outcomes, meaning that you take your inputs, you conduct your activities in the short term, create outputs for sale, but in the longer term, there are these perhaps distressing outcomes like climate change. And they changed that. That's no longer outcomes with a general focus on the long term. They added more words in there, and they're trying to make it very clear. The outcomes, as in the impacts of climate change, can be short-term or medium-term or long-term in nature. So my point to you, first of 2 points, is that, in my opinion, what is remarkable about this 8 years in the making revision to the 6 capitals model is not how much the model has changed over a 6-year period where the world has changed dramatically. It's how little it has changed, which I actually think is a pretty good sign that the fundamentals of the model are pretty secure. Now let me close with the thought or the question that I opened with, which is to say, the question is just how many capitals are there? Many people insist 5. I've heard some say 8. We had a good debate over that, and I think we grudgingly agreed that 6 capitals as listed here are the capital categories that people most often look at. However, I am a contrarian at heart, and so what I would say, and again, got to throw out some contrarian thoughts to get the conversation rolling in the next part of our session together, that you should really think of capitals, each capital category, as anything that you might invest in that might have a long-term impact on sustainability. And so if, for instance, you say, you know something, I have two very different categories of human capital. I mean, I work for a university. We have faculty. We have basically people. We have administrators. Very, very different types of human capital. You develop them differently. They produce different types of value. Should we take those three different types of human capital and split them out to three categories, thus making sure that my university has 8 capitals instead of 6? Oh, what a horrifying thought amongst the purists who like to stick to 6. But I think you should. And I think that's important because the more granular you can define your capital, the more precise you can measure return on investment in that capital. Anyway, that's all that I wanted to say. Thank you very much for bearing with me. And now what I'd like to do is throw the floor open to conversation. If any of my 3 colleagues have a follow-up thought about anything that we said or anything that is being texted into the chat room, by all means, do speak up.
Emily, can you tell us what investors in Generate Capital want to see? Because they're looking for not only a financial return, but they want some return on environmental capital or other of those resources.
Yeah, I guess what's interesting about all these different types of capital that we're talking about is a lot of people have thought about defining what the capital is or trying to understand risks to capital. And what we're much more focused on is trying to find the opportunities in those capital piles and how you can accelerate capital. So what we're really looking at is taking what we can scale, whether it's community solar or hydrogen fuel cells, and that is sustainable because we really believe that sustainability pays, and that this technology is the most affordable and most reliable systems we can have, and to readjust the system so that it optimizes and uses those resources based instead of the legacy system that we have. Does that answer your question?
Well, are there like a big 3 or a big 5 that you always report on? Like energy saved or emissions reduced or some other type of?
Sure, we're always looking at emissions reduced. I mean, everything we do is sustainable. So everything is offset something somewhere. It's all hydrogen fuel cells or anaerobic digestion or any way that you could choose a more sustainable outcome than most people would choose today. And our biggest competitors are always, what exists already, a landfill or a fossil fuel infrastructure system that is there. So yeah, we look closely at that. We look at jobs created. We look at profit. It all goes together. Like you want anything that you create that is sustainable to be able to be financially sustainable as well.
Super. Yeah, that's the interesting thing is to attune it to what investors are seeking for and to have them understand not just the financial return output, but that these other capitals have a return. So an environmental return is, increased biodiversity and sustainability, but to make that even more specific, that's why you have like a greenhouse gas emission that you can also tie to a science-based target. So what's really exciting is more than 1,000 companies have these science-based targets that they've committed to, and even companies like Microsoft seeking to net out all the carbon they've ever emitted since being founded in 1975. But investors also want to see like employees and employee metrics, and are they being paid fairly, and how are they being paid relative to the CEO? And then one of the capitals that may not always get enough attention is like trust. And so from a company perspective, when companies get sued, they're getting sued because they've broken trust in some way. They've done something to the customer. They've underpaid employees. They've steal intellectual property from their competitors. They're breaching trust in some way on all of these capitals or stakeholders. So that's typically a good leading indicator, is if a company is being sued, there's something wrong with the governance. So Daniel, what about you? You figured out how to put values on these things, right?
Yeah, that's right. And what's interesting is that I don't think that just putting a value on it is enough, but I do think, as we heard earlier today from Bob Willard, that it's a big barrier. People think, well, you know, I don't know if it's really worth it. I think people will get more out of it. They'll be generating more action if there's more benefit and if they see the risk. We've seen from, for example, from psychology that people have more loss aversion. It's true, opportunities are very, very attractive, right? Everybody who deals with an entrepreneur or whatever sees that. But a lot of companies who haven't yet taken enough action, if they saw more risk, they might. And one of the things about the value here is that there's tremendous value in all these things. For example, we actually have a long quantification of the value of trust, as you were just mentioning, Paul, in the book. And if it accelerates the speed with which things happen, it matters. There's also, in the 3D risk model that I showed you the dashboard for, there's a quantification of the value of decision-making prowess. When you use, say, OODA is one version of the framework for decision-making. But as a simple example, right, it's not that we didn't know that pandemics were a potential issue, but I'd like to ask people who are here to put this in the chat. How many organizations do you know that had purchased pandemic insurance before COVID hit? Now, we had SARS, we had swine flu, we had all these pandemics. How many of you even knew there was pandemic insurance? Just go ahead and type that in the chat. But in the meantime, let me just say that pandemic insurance is a real thing. It was offered by Munich Re, one of the largest reinsurers, best reinsurers in the world. And the answer to the question is they had one customer. They had one customer. That's how many people, in spite of having seen this before, didn't make a decision about it, right? One of the great...
What was the price and what's the expected payout? Because that's another, because we have earthquake insurance in California, and sometimes it just makes sense to self-insure because the price is too high and the coverage is too low. So do you know anything about the details about I agree with your question about the pandemic risk, but the insurance sometimes depends on those 2 points.
Okay, so let me ask, if you were, say, going to self-insure, and I used to work for IBM, I used to lead sustainability strategy consulting for IBM, which is a very large company and self-insures in some things, then you would expect to see, let's just ask hypothetically, if your hypothesis is companies self-insured against these risks, did they do it? So did Delta or American or United or Hertz, did they have a huge asset on the books that was there because they understood that any sort of pandemic might destroy their entire industry and their business? And they didn't need government bailouts. They didn't need to have insurance because they were ready for that. And the answer is clearly no. We had entire industries and companies that were caught by surprise. And that's what I mean, is that it's not that you have to pick any specific way of insuring. I mean, obviously you could have bought the insurance. You could have self-insured. You could have done a lot to reduce your vulnerability. One of the things in the 3D models, fundamentally speaking, there's a lot of risk that's submerged. And when people find out about it, it's often too late. That's one of the tremendous values of looking at things through the 6 capital lenses, is you see submerged risks before it's too late to do anything.
Yeah, this is a great point on the submerged risk, or submerged in the future risk, like some of the movies show, like the Day After Tomorrow. Last year, for example, speaking of multi-capital, the 2017 tax cut law, which reduced government inflows, did one other thing and created something called opportunity zones. So there's more than 8,000 opportunity zones around the country. I'll be curious, Emily, if any of the Generate Capital energy facilities are in opportunity zones. And so there's an opportunity in the opportunity zones to invest in infrastructure, real estate, as well as businesses, and maybe even tie it to climate action. But what I can tell you is from having interviewed those opportunity zone fund managers, the majority of them were just focused on real estate properties that served high income or upper income, not lower income. And amazingly, when we said, okay, where are these properties? They're in Miami and Houston and Baltimore. So when I asked the fund managers, I said, have you done a climate analysis of the risks of being there? They said, oh, we'll just insure for that. Not understanding that if Miami goes underwater, will the insurance companies pay out? Will reinsurance companies pay out? And not even thinking it through of like, maybe we shouldn't invest there. We should invest somewhere else. But Emily, how about you? Are there facilities that are in opportunity zones? They have other social characteristics?
A couple thoughts on insurance to begin with, and then I'll come back to where facilities can be in the future. But I think, a lot of people thought they might have business interruption insurance or something that would cover a pandemic like this. The World Bank sold, pandemic insurance type bonds that just didn't even actually pay out over this pandemic because it didn't trigger it enough. And that was for emerging markets. So insurance is not necessarily the best way to do it. The way we think about capital and deploying capital and creating infrastructure is that you're creating infrastructure that is sustainable, but also deserves to be here for the future. So, it is better and able to be more reliable and consistent over the longer term. And if you think about it that way, you think generations forward, infrastructure is built with at least like a 25 to 30 year timeline. So a lot of the people who will benefit from any infrastructure we create are not even born yet. So if you think sometimes 100 years, so you have to think out much further in terms of saying this deserves to be here for another generation. So that's how we think about it. But then also, if you want to look at where we could put infrastructure today, we definitely have some assets in opportunity zones before they were even opportunity zones and designated. But there's a huge opportunity right now to put infrastructure in rural areas that is sustainable, whether it's community solar or anaerobic digestion, and create opportunities for agriculture through sustainable infrastructure that improves our food system, improves the way we use energy. There's a huge opportunity to keep doing that.
Here in Houston, the restaurants, including the fast food restaurants that reacted most quickly to shift from inside dining to takeout are the ones that were actually focused on hurricane risk, flood risk, if you will. And so many of them did a number of things. Number one, they literally raised the restaurant, and you can do that to try to divert the water around it. But number two, they built out multiple takeout lanes under the supposition that if there's a flood, people are still going to have to eat, but they're really not going to want to come in and relax and have a good time. And then they got very good. Instead of going from 1 lane to 3 lanes, which triples your supply chain, if you will, they trained their employees to take iPads or other kinds of tablets, and they tossed out 4 to 5 employees per row, and there were 3 different rows at that point. So you effectively they trained themselves to have 12 to 15 times the delivery capability, assuming their kitchen could handle the volume, than they otherwise would. There are other restaurants and fast food outlets that didn't do that, and they sat there for months watching their competitors serve 12 to 15 times as many people as quickly as they did. My point, though, is that they weren't focused on pandemic. They were focused on a very different type of risk, but it was that process, that culture of thinking about what could go wrong and what is the cheapest and most effective infrastructure that you could build? And to what extent could you rely on your own employees, holding tablets in this case, to supplement the infrastructure that you could build that made all the difference? Culture, training, flexibility, and an ability to accept the fact that if you invest in a risk response capability, you might be investing in the wrong capability depending on what risk blows up in your face. But if you get in the habit of thinking flexibly and responsively, you could still do well. And some actually have done excellent. I mean, much better than they might have done.
And I think that's a great point. And it's a great example because what they were thinking about was an environmental risk. And what happened was health risk. But these are both related in the sense that they're both bedrock services and foundations of the economy that we expect to be there. And when you start thinking about, well, what happens if one of these bedrocks cracks, if there's a shift or a figurative earthquake, that gives you additional benefits in building the internal infrastructure. The 3D model includes the threat, things like rising sea levels. That's 100%. Then there's the vulnerability. And vulnerability is in large part driven by these kinds of preparations and these kinds of thought habits, right? The things that you're talking about, but also things like how quickly do you adapt? We've seen cases in this country where there were existing plans for exactly this eventuality that did not get used. That is a type of vulnerability that does not show up in a traditional risk analysis. You call it whatever you want, but that inability to make a decision, that inability to take an action, that inability to learn, and then there's the ability and the will to continue to take the action, as opposed to saying, oh, okay, we did as much as we can do, we're tired, we need to stop. That is a vulnerability as well. And when you look at risk differently, you see those vulnerabilities, you prepare for them, and then they're opportunities instead of potential life-threatening, business-threatening problems.
Yeah, good.
And the specific scenario, when you're doing your scenario analysis to imagine, to model out those future risk events, the most difficult scenario to accept is the scenario that says, what I prepared for, I will not be able to rely on my own employees, whom I have trained, I thought, to do what they should do. There are many communities in hurricanes that actually strand people in the hurricane zones because they do have modalities of transportation to get them out, but at the time of crisis, the bus drivers don't show up to drive the buses. And as a result, the buses don't roll and people can't make it to safety. It's your own people failing you that you never want to acknowledge. It's just human nature. But if you don't acknowledge them and if you don't explicitly build them into your future risk scenarios, you're going to be caught blindsided.
This actuarial way of thinking about risk is not really incorporated in our financial markets that well. I guess you can sort of see that over the past year, obviously with the pandemic interrupting so much, but even before that with environmental risks, like you think about Puerto Rico, it's clearly in a hurricane zone. It has key energy assets that are located, a mile from the coast. And if you think about how that place is going to survive in the next 20, 30 years, like there are going to be more hurricanes there. But if you talk to like a credit rating agency or someone else in the financial markets, they probably are only planning for some sort of crisis in the next 3 to 5 years. They're not planning out 30 years or 20 years, even though that's how long the life of that infrastructure is probably built for. So that's really probably one of the key changes we need to go through as a financial system, is to say, well, these risks are not 100-year risks, they're not 50-year risks, they're happening today, and they can be incorporated today.
Yep.
Yeah, it is very much an actuarial model. The idea that if you own that facility, then you don't simply own the most likely future cash flows, present discounted back, but you actually own a portfolio of potential future events, some better than expected perhaps, or some worse than expected, and some catastrophic. And so the game is being able to identify what's in that portfolio. That's the full range of really, really bad futures and everything in between. And when things come along like climate change with, Daniel, as you said, a 100% likelihood of having a significant impact. To segue over to Scott's point from a few seconds ago, a 100% likelihood perhaps that we're going to have temperature increases worldwide well above the 2% threshold.
Well, we have an on-demand graphic here, and I love bringing up this graphic because we start talking about degrees in Celsius. But in the US, we think in Fahrenheit, not Celsius. And we talk about the globe saying, oh, I don't mind if it's 1 degree cooler or 2 degrees cooler or 10 degrees cooler, especially if you're in Minnesota, 10 degrees hotter. But if we equate that to the human body temperature, and we think of the Earth's temperature as our human body temperature, Scott in the chat is bringing up a point of, well, what if we hit this 2.7 to 3.6 degree pathway? And that means that our body temperature, our Earth, will be running a fever all the time. And there's some estimates, and I think Emily may have written about some of this in the past few years, is investing in the S&P 500 or an investment index is actually dangerous because that's a 5 degree Celsius world or a 7.2 degree Fahrenheit world. And that means your temperature all the time is 106 degrees in your body. And either that implies either A, you have Ebola, which is where we're headed, or B, you're dead. So this is what's happening right now is CDP, the Carbon Disclosure Project, is asking companies to translate their carbon emissions into a company-specific score, and what is your company-specific Celsius, Fahrenheit, and hopefully human body temperature translation. And we need to get more motivated to move more quickly, or otherwise we're going to encounter all these risks and more that we're not even predicting.
Yeah, two quick points. One is that, yes, the financial system needs to have this long-term view, and it doesn't, but also companies and investors can do that. So that's one reason why when we have the dashboard, you can choose your time horizon and you can see the difference in the 20-year investments and the amount of risk that you have and what types of risks there are. The other thing is that there's a lot more submerged business risk that happens sooner that people don't see, and that's eye-opening. For example, right now, about 40 to 50% of all the apparel is sold at discount and it's getting worse. Why? Because seasons are less predictable. And one of the largest economies in the world is California. And if things continue on their pace for a little while, the infrastructure damage to Northern California will, quote, paralyze road transportation. Road transportation. That's how everyone and everything gets everywhere in one of the biggest economies in the world. How many people are incorporating that into their financial model, their investment model, into their business planning model?
I would add to that it's not just about incorporating this risk, right? Like I see all these investors trying to put a number on their portfolio and say my portfolio is a 6 degree portfolio or a 1.5 degree aligned portfolio. But even if you have a 1.5 degree aligned portfolio today, you're not invested in like the corpus of what is in the global economy. So what you have to do is get everything that is, an investor today might see their portfolio and see it's 6 degree aligned, okay? And that's where there's no way we can live on a 6 degree world. So what you have to do is take that whole corpus and move it to a 1.5 degree world. And that is different than just avoiding risk. That means you have to actively engage the risk and figure out how to offset it. So one thing we're trying to do is to say, hey, here's this old technology like solar, and it can be deployed more or even like hydrogen fuel cells. That's technology that's available today and can be deployed more rapidly and more quickly. But you have to take risk out of it so that people will use it. So you have to change the way that you fund that. You have to change the way you think about deploying it. You have to have people be okay with that risk and figure out what you can do to financially offset it.
Yeah, and
now, guys, I hate to be a taskmaster. It's the thankless job of being a moderator, but I think we're 50 minutes in right now into the hour. I see we have a time left clock at the top of our screens, but it says we have 2 days, 4 hours, and 24 minutes left.
There's a lot of capital risk,
for
a
the
lot of
conference
multi-capital
event and not for our session.
and that wouldn't be enough.
Understood. That's true. That's absolutely true. Be that as it may, perhaps it would be helpful for us to have a lightning round and to just express a closing thought, whatever it might be that we might want, the thought that we want to leave our participants with as they move their way through the conference.
Well, I'll start. Yeah, so there's 10 years of new metrics that we've talked about. Daniel's been here since the beginning. Each of us on this call have been working on this for most of our lives. And so the key is look for incremental action that you can take to start implementing as soon as Friday. And that could be anything from talking points, like what's your body temperature of this organization, environmentally speaking, to how to engage your employees more deeply, to having the CFO look at things like, if we put people on the balance sheet as an asset, the productive capacity of people on the balance sheet, which has been the subject of multiple PhD theses going back as far as the 1960s, what would that look like? Let's not think of people as a cost. Let's think of people as an asset. And since our CEOs say people are an asset, what can we do? There might even be another session that's going to be around 401ks. And so that's another way to get your organization more engaged and to get dozens or hundreds or thousands of people engaged at once. Emily, you want to go next?
I'll go next. I would just say that one thing here has showed us is that probably scoring risk is not enough, and there is more risk in the system and things are more connected than we thought of. So we should just keep trying to think longer term about what we're doing and knowing that you have to engage the risk. You can't just let it be and avoid it.
Yeah, and I would say it's important to convert these risks into actions internally and for your external influence. That you can take something where you quantify them, you look at them, you look at the vulnerability. If this risk happens, what's our vulnerability? You find the opportunities, everything else. But when you measure them and you quantify them, you do three things. First, you prove how vulnerable you are. You get woken up to submerged risk. Second, you then know how to improve. Okay, now we know the drivers for our vulnerability. What can we do to improve that? Whether it's changing this or making a shift in that or what have you. And the third thing is you can become a catalyst. We don't just need the people here to do better. It's great if everyone who's at this conference shifts to a 1.5 degree portfolio, but we need the entire global portfolio to shift. And that means being a catalyst. And sometimes measuring, acting, and talking about things as they really are helps make that shift happen.
And I'll close with a financial observation. One of the biggest problems that we've all faced is that the benefits of shirking our responsibility to future generations have created savings in the short term. And until recently, at least, the catastrophic costs of doing that have always been pushed out to the very long term. And actually, the worst of the catastrophic costs are still out in the very long term. And so when your accountants or financial folks come in and do a classic net present value analysis, the future cash flows get discounted and to the point where they just don't seem to be so worrisome. However, as the interest rates start to decline towards zero, and this is just quant stuff, but as the interest rates that are out there start declining towards zero, then the power of the discounting factor gets small, and those future costs become more important, more powerful in comparison to the current costs. If in real terms interest rates hit zero, and arguably at this point in real terms they pretty much are zero, then future costs many, many years out are as powerful an impact as current costs. And of course, in certain areas of the world and at certain times, interest rates turn negative. In theory, at least, according to financial models, when interest rates turn negative, well, the world turns upside down and we're on the bizarro world, but financially speaking, future costs become more powerful in your cost-benefit calculation than current gains. And so the more and more that we hear about us living in a permanently close to 0% interest rate environment, the more accountants and financial folks and economists turn out to be your friends, because the more weight is placed on those further out future costs. I hope that's helpful. I hope I didn't end the conversation with an overly quantitative perspective. Something to keep in mind. I see it's 41 minutes after the hour. Depending on your time zone, it might be a different hour. I believe we are ready to wrap up at this point, unless one of us would like to chime in with a final overtime.
One small optimistic note after what you said, which is that there's a lot more value, a lot more opportunity, as Emily pointed out, to do something about the current costs and benefits as well as the long-term ones. That's what's so great about this, is seeing the opportunities and the chances to do a lot more, a lot sooner.
There was a science fiction project, at least I thought of it as science fiction for many years, that we were going to build gigantic machines to suck all the carbon dioxide, methane, and other gases out of the atmosphere. Now, what we would do with them was never really thought out, but the enormous cost of simply scrubbing the atmosphere clean after we pollute it always made it impractical. And yet I'm starting to see here and there little comments about people looking into that. And it's not just because the technology has become extremely more feasible, it's because the cost-benefit equation has changed. And so in a sense, well, this is a contrary way to be optimistic. The worse things get, the better the proactive solutions.
I'm going to end on a true note of optimism and just say that we actually have so many solutions today that can be deployed. It's just a matter of will and risk tolerance. And there are lots of political and financial ways to offset that. So we just have work to do.
I'll just give one last plug for things like green transition bonds and fossil fuel-free investing and gender lens investing. So all those will be in the new book published by Wiley called The Global Handbook of Impact Investing, and the link is in the chat.
Thanks, everybody.